Welcome to today's exploration of the sources. You're here because you want perfectly distilled, actionable knowledge from the front lines of finance, but, without that paralyzing information overload that usually comes with it.
Right, exactly. You want to cut through those terrifying news headlines and just look at the raw data driving the US stock market today.
Yeah, and the material we're unpacking today is incredibly timely for that exact mission. We're looking at this highly detailed internal strategy session from a leading financial firm. It's dated early 2026.
And this data paints a pretty stark picture. I mean, we are looking at a market grappling with massive geopolitical shocks, specifically an ongoing escalating conflict involving Iran. But at the exact same time, it's trying to price in the wave of an unprecedented technological revolution in artificial intelligence.
It really is a market of extremes right now. So the mission for our time together today is highly focused. By the end of this conversation, we're going to provide you with a clear summary of the current U.S. stock market.
Yeah, and we'll reveal whether the analyst's consensus at this financial firm is a BUY, a hold, or a sell. Just one definitive stance.
Exactly. And finally, we'll deliver a structured report on a specific sector leader covering its investment thesis, potential risks, and valuation reference.
It's essentially a pragmatic roadmap for navigating a macro environment that feels, frankly, incredibly volatile right now. We're stripping away the emotion and just looking purely at the mechanics of where the capital is flowing.
Let's start with a summary of today's U.S. stock market, because the tension in the charts is, well, it's palpable.
Oh, absolutely.
According to the internal data from the firm, the S&P 500 is experiencing its tightest trading range for this time of year since 1928. And the Dow is seeing the tightest range since 1896.
Which is wild to think about. We're talking about over a century of historical data, and we are currently sitting at the absolute extreme of market compression.
Right. When you look at historical precedents for that kind of price action, it tells a very specific story, doesn't it?
It really does. The market isn't just going to sleep or losing interest here. It's building immense pressure. Think of it as a massive buildup of kinetic energy just waiting for a catalyst to dictate a directional breakout.
It's like a tightly coiled spring. The tighter that compression gets and the longer it lasts, the more explosive the eventual expansion is going to be.
Exactly. The energy has to go somewhere eventually.
But I want to look at what's actually pushing down on that spring right now, because the headwinds outlined in this strategy session are significant.
They are. We're looking at some severe macroeconomic crosscurrents. The most immediate headwind is obviously the geopolitical situation involving Iran.
Which has sparked a sudden and really aggressive oil price shock. Initially, we saw crude oil prices spike by 50% almost overnight.
Yeah, and the sources note that is directly tied to the Strait of Hormuz. When 20% of the entire global oil supply flows through a single vulnerable choke point, the market is practically forced into a defensive posture.
Right, even if the strait doesn't fully close, the mere threat of a supply chain disruption of that magnitude sends ripple effects through every major index.
And that underlying fear is translating into extreme pessimism across Wall Street right now. The sentiment surveys in our sources show bears heavily outweighing bulls by a massive margin.
Institutional and retail investors alike have been aggressively buying put protection. In fact, the data shows they're paying record premiums to hedge their portfolios against a catastrophic market crash.
Yeah, and I'm looking at the labor market data in the strategy session too, which adds another layer to that pessimistic narrative. Job openings have dropped down to 6.5 million.
Right, which marks a pre-COVID low. It's a definitive indicator that the labor market is cooling off, which naturally raises concerns about consumer spending power in the coming quarters.
Normally, those headwinds, a major geopolitical conflict, violent oil spikes, extreme bearish sentiment, and a cooling job market that would be more than enough to send the broader markets into a prolonged tailspin.
But the data shows the underlying U.S. economy is actually proving remarkably resilient. Real GDP growth is holding steady at 2.2%.
Which means consumers are still spending, despite all the macro anxieties floating around.
I was looking at these productivity numbers in the report, and they just seem massive.
Hmm.
Are we really comparing this current data to the late 90s dot-com boom?
We are, yeah. The parallels in the data are striking. We're in the middle of a massive structural productivity boom.
The data shows a 5.2% annualized productivity gain in the third quarter of 2025, right? Followed by a 2.8% gain in the fourth quarter.
Exactly. And the analysts in the strategy session explicitly mapped these numbers against the explosive late 1990s internet rollout. But this time, it's entirely driven by the rapid enterprise integration of artificial intelligence.
That productivity boom is fundamentally altering corporate margins, isn't it? Companies are automating complex workflows, doing significantly more with less, and expanding their profitability without having to hike prices on the consumer end.
Spot on. And we're seeing that profitability reflected broadly across the market. This isn't just a handful of tech monopolies dragging the major indices higher while everything else suffers.
Yeah, it's not just the heavyweights doing the lifting here. The advanced decline line recently hit new all-time highs.
Which is a crucial metric. We're seeing incredible market breadth. That tells me there is broad participation across multiple sectors, industrials, financials, utilities.
It's a much healthier market beneath the surface than the terrifying geopolitical headlines would suggest.
Right, that broad participation provides a really solid foundation. When the rank-and-file stocks are breaking out alongside the megacaps, it suggests the underlying liquidity and economic health are robust enough to withstand significant external shocks.
So we have this historic market compression, severe geopolitical headwinds, but massive underlying economic and technological strength. This brings us to the million-dollar question.
The big one.
Based on the internal data from these top financial analysts, what is their official stance on today's U.S. stock market? Are we looking at a BUY, a hold, or a sell?
Synthesizing all the internal data, the technical indicators, and the macro environment, the definitive consensus from the financial firm's analysts is a resounding BUY.
Wait, so even with retail sentiment, that bearish, an ongoing conflict in the Middle East, and a 50% oil spike, they're slapping a BUY rating on the broader market. What's giving them that kind of confidence?
It's a mix of market psychology, hard technicals, and historical data. Let's start with the technical risk and reward setup.
Okay, lay it out.
The analysts point out that the Nasdaq Q100 recently pulled back to test its 200-day moving average. For institutional money managers, coming into that specific trend line from above offers one of the most reliable, historically proven risk-to-reward ratios for taking a long position.
It essentially functions as a massive structural support level.
Exactly.
And if you combine that technical support with the contrarian angle we discussed earlier, you mentioned the extreme pessimism and everyone buying record amounts of put protection. Counterintuitively, that's actually a bullish signal, isn't it?
It is a classic market paradox. When fear reaches an absolute fever pitch and every major player has already purchased their downside insurance, there's essentially nobody left to panic sell.
Right, the capitulation has already occurred.
Yes, that creates a vacuum. In that kind of environment, the market doesn't even need overtly positive news to rally. Just the mere absence of catastrophic news forces prices to climb higher as short positions are covered and underallocated managers are forced to chase the momentum.
That psychological dynamic ties perfectly into the 39-day rule outlined in the sources. I found this part of the strategy session really fascinating.
Oh, it's brilliant. The analysts looked at how the market historically reacts to sudden, violent geopolitical events, wars, targeted strikes, sudden sanctions.
And the immediate reaction is always a spike in volatility. It's a knee-jerk, emotional response to uncertainty.
But the market is a brutal, forward-looking discounting mechanism. It consistently prioritizes long-term economic fundamentals over short-term political chaos.
Think back to the Gulf War or the initial shock of the Ukraine conflict.
Right. The data from the strategy session shows that, on average, the market fully absorbs the new reality, prices in the geopolitical risk, and fully recovers from those specific types of shocks within exactly 39 days.
It just pivots right back to corporate earnings and economic growth. But there's a fourth element to this BUY rating, and it involves a legendary investor referenced in the sources.
Yes, who argues that conventional economic measures are often just noise. The actual fundamental driver of market direction is liquidity.
And if you track the liquidity pipelines right now, the setup is incredibly bullish. We have an incoming Federal Reserve chair who is widely expected to be highly dovish.
On top of that, the firm is tracking data that anticipates record-breaking tax returns hitting the U.S. economy later in 2026, which will inject raw cash directly into the system.
Add in the massive corporate margin expansion driven by AI efficiencies, and you have a historic pipeline of liquidity waiting to flow into equities.
So the data strongly supports a BUY position, but the analysts are very clear about one crucial technical caveat here.
Right, this entire bullish thesis holds true, provided the major indexes stay above that critical 200-day moving average. If that technical safety net breaks on high volume, the thesis has to be completely reevaluated.
The moving average really is the line in the sand. But even if the technicals hold, we have to address the major macroeconomic debate dominating the strategy session.
The elephant in the room, inflation.
Exactly. The critical question is whether this sudden oil shock and the newly proposed reciprocal government tariffs are going to cause a massive second wave of inflation.
And this is the fiercest debate happening in finance right now. Our goal here is to impartially report the two arguments presented in the internal strategy session without taking a side. Let's just look at the data.
Fair enough. Let's start with the bull case, which argues that an inflation spike is not just possible, but imminent.
The bull case is anchored in the immediate observable data and the potential for a policy misstep, right? The recent oil shock has already added 0.2% to the broad consumer price index.
Yes, but the analysts arguing this side say the real threat isn't the price of crude today. It's the economic weakness that sustained high energy costs could cause 6 to 9 months down the line.
Because if those energy costs drag down industrial output and squeeze consumer wallets, causing genuine economic weakness, the Federal Reserve might feel forced to intervene.
The argument is that the Fed, terrified of a deep recession, would aggressively print money to stimulate the economy.
And a rapid increase in the broad money supply M2, combined with the major tax cuts implemented by the current administration, creates a textbook recipe for inflation.
You'd have too much fiat currency chasing too few goods. The bull case argues this combination could easily trigger a severe, sticky second wave of inflation that the Fed will completely struggle to contain.
It's a very credible concern. But the internal strategy session also lays out a highly compelling bear case, an argument for sustained disinflation.
Yeah, the bear case relies on deep historical data and real-time private tracking metrics. Let's look at the tariff argument first.
Mainstream economists had previously modeled that the reciprocal tariffs would cause a 9% inflation spike. However, the year-over-year CPI has stubbornly stayed right near the historical norm of 3%.
The analysts cite a massive 150-year dataset study on tariffs to explain this. The conclusion of that century-and-a-half of data is that a tariff is essentially a tax, and it causes a one-time negative demand shock.
Meaning it forces a single price adjustment across the supply chain, but it does not act as a persistent compounding driver of a month-over-month wage price spiral.
Furthermore, the bear case points to real-time inflation trackers. Government data inherently lags by months, but these private trackers analyze millions of commercial prices instantly.
And the data in the strategy session shows that real-time inflation has actually plunged to 0.79%.
Less than 1%. You add the fact that shelter costs, which make up a massive 35% of the CPI, are visibly cooling off.
And then you factor in the AI productivity boom we were discussing earlier. By structurally lowering corporate operating and labor costs across the board, AI is acting as a massive natural deflationary force across the entire global economy.
It really is a profound structural debate. You have the looming threat of future money printing and energy spikes battling against the real-time deflationary forces of artificial intelligence and cooling shelter costs.
So we have the market summary, we have the definitive BUI verdict, and we understand both sides of the inflation debate. Now, I want to pivot to application.
How does a listener actually act on this BUI rating?
Exactly. According to the analysts, you follow the massive capital expenditure flowing into the system.
And the numbers involved in this CapEx cycle are staggering. The hyperscalers, the absolute biggest tech giants in the world, are projected to spend $515 billion on AI infrastructure this year alone.
$500 billion on infrastructure in a single calendar year. It makes you feel a little better about accidentally overspending on your monthly cloud storage bill, doesn't it?
It's an astronomical amount of capital. And to capture a piece of that $515 billion pie, the financial firm's strategy session highlighted a specific sector leader.
It's a pure-play AI memory and storage company that was recently spun off from its legacy hardware parent.
Let's break down this opportunity using the exact structured framework provided in the sources. We'll cover the investment thesis, the potential risks, and the valuation reference.
Starting with the investment thesis, what is driving the core conviction here?
The fundamental investment thesis rests on the physical reality of data centers. This company provides high-performance solid-state drives and enterprise-grade flash memory,
Which are the literal physical building blocks required to construct AI infrastructure. You cannot train or run these massive models without this specific hardware architecture.
And the demand is so extreme that the firm notes this company's enterprise flash production slots are completely sold out through late 2026.
They literally cannot manufacture the hardware fast enough to satisfy the hyperscalers.
What's driving that insatiable demand is the evolution of the software itself. The analysts highlight that we are currently moving away from standard generative AI.
Right, we're moving toward agentic AI systems that execute autonomous, multi-step workflows 2047 without a human in the loop.
And eventually, this leads to physical AI powering advanced robotics and autonomous fleets. All of that continuous autonomous computing requires an unimaginably vast amount of memory storage.
The investment thesis also includes a massive institutional catalyst. This specific stock was recently added to both the S&P 500 and the Nasdaq U100 indexes.
That means massive institutional funds and passive ETFs are structurally forced to buy millions of shares regardless of the price, creating a continuous wave of underlying buying pressure.
But a proper analytical framework requires looking at the downside just as closely. Let's move to the potential risks.
First and foremost, this is a high momentum stock. It moves fast in both directions.
If the broader market breaks below that 200-day moving average we discussed, or if this specific stock breaks below its own 10-week moving average, the technical safety net vanishes.
The downside volatility in these high flyers can be severe. The second major risk outlined in the report is geopolitical spillover.
This entire bullish thesis relies heavily on the containment of the current conflicts. If the situation in the Middle East widens significantly, dragging in more state actors and persistently disrupting global supply chains, all of these optimistic hardware projections are off the table.
Finally, there is a distinct liquidity risk warning in the sources. While the specific memory company we are analyzing is highly liquid, the financial firm strongly warns against buying low-volume tech infrastructure stocks.
Specifically, they advise avoiding anything trading under 100,000 shares a day. In a volatile market, illiquid stocks lack the massive institutional support needed to sustain a rally or buffer a sudden drop.
You can easily get trapped in the position, unable to exit at a fair price.
Which brings us to the final component, the valuation reference. How do the analysts justify issuing a BUY rating on a stock that has already run up so aggressively?
It comes down to a fundamental re-rating by the broader market. Because this company was spun off, it is no longer being valued as a slow-growth legacy hardware provider.
The market is now correctly valuing it as a high-growth semiconductor firm, and the multiples are expanding to reflect that.
And the raw performance data justifies that new valuation model. Over the last 4 quarters, this company has beaten Wall Street analysts' earnings expectations by an astonishing average of 371%.
They aren't just beating estimates. They are entirely rewriting the models.
Because of that massive outperformance, analysts are projecting triple-digit growth in both the top line and the bottom line, extending all the way through 2027.
When a company grows its forward earnings that rapidly, it actively compresses the forward price-to-earnings ratio. That means even though the stock price has surged recently, the actual valuation remains highly attractive relative to its immense future growth trajectory.
Let's pull all of this together for a second. The S&P is currently compressed like a tightly coiled spring amidst some very severe geopolitical headlines, an ongoing conflict involving Iran, and violent oil shocks.
But because of a robust AI-driven productivity boom, strong technical support at the 200-day moving average, and a contrarian vacuum created by maximum bearish sentiment, the analysts at this leading financial firm have issued a definitive BUY rating.
And by tracking where the massive $500 billion capital expenditure is flowing and using a structured framework, always weighing the investment thesis against the potential risks and the valuation reference, you can strip the emotion out of investing.
You follow the data, you manage your downside, and you ignore the panic. It's about having the right map for the territory.
It absolutely is.
But before we wrap up, I want to leave you with a final provocative thought to mull over on your own. We talked about that massive shift toward agentic AI driving hardware demand.
We're talking about artificial intelligence that doesn't just wait for a prompt, but acts autonomously on your behalf.
If agentic AI takes over our inboxes, manages our complex schedules, and autonomously executes our purchases within the next 2 years, how will that change not just the mechanics of the stock market, but what it fundamentally means to be a human navigating the digital world?
It's a profound paradigm shift that is going to impact every aspect of daily life, far beyond corporate earnings and infrastructure spend.
Something to think about as you watch these technologies roll out. Thank you for joining us on this exploration of the sources. Remember to stay curious and keep learning.